Hello there. My name is Pavel Konechny. I'm the Chief Investment Officer at TriStar Trust. Today with us, we have Becky Carrier. She is one of the senior members of the investment team. Becky, why don't you tell us a little bit about yourself?
Sure. Hi, Pavel. So I graduated from Saginaw Valley State University in 2000 with my bachelor's in business. Then I went on to Central Michigan University and graduated with a master's of business administration in 2002. And shortly after, I did join the finance world in 2003, and I have been managing money ever since.
Oh, nice. So we usually start the segment with people thinking about things, but I'm going to change it up a little bit. I'm going to ask you, Becky, what have you been up to?
Well, myself and the entire investment team have been very busy the last few months working on tax loss harvesting.
Tax loss harvesting. Tell us what is tax loss harvesting?
So, tax loss harvesting is when you sell securities to realize losses in an account, and typically you do that to offset capital gains. In most situations, you want to do that when you have short term capital gains because the tax rate in short term capital gains is much higher than long term.
So how do you go about doing it?
So, what you do is you identify within the portfolios the securities that currently have unrealized losses. You place the trades to make them realized losses. And then after 31 days, you will be able to buy those particular securities back should you want to continue to hold them.
So you're saying that you still may have faith in the performance of the security in a long term, but you're just taking advantage of the fact that there's a loss.
That is correct. So this year actually provided a wonderful opportunity to be able to do this because we had ended the longest bull market in history earlier this year with the large drop in the market in March that put us into a bear market. So with that drop in the market, that provided great selling opportunities to be able to sell those assets. And then we've been slowly purchasing them back after the 31 days.
I see. What's the difference between the short-term capital gains and long-term capital gains?
So short-term capital gains are going to be any assets that you hold less than 1 year, and long-term are going to be any assets that you held for over 1 year. And the tax differences is short-term gains, you would pay your regular income tax rate. So that's why they tend to be a lot higher for most people. But for long-term, you do pay what's called a capital gains tax rate, and that will be based on your taxable income. And there is a chart that you'd be able to work with your tax advisor on.
Oh, perfect. And if I understand it correctly, taxes, capital gains taxes, have a pretty material impact on the performance or the annual rate of return. And if I remember correctly, there's been some studies done that suggest that the return difference may be all the way up to 2% annually when taxes play a role. Is that right?
That is correct.
All right. Becky, tell the people that are watching, just share, do you have any advice for them?
Yes, my advice would be if this interests you, if you think this is something that would work well for your own portfolios, please work with your tax and or financial advisors before you proceed in any tax loss harvesting, just to make sure it is the right thing for you.
Okay, perfect. Well, Becky, thank you very much for your time today.
Thank you.